Welcome back to another episode of Wall Street Review. The following analysis is for educational and professional purposes only. It does not constitute investment advice. For most of financial history, raising capital meant literal physical proximity to the bankers on this street. It was a slow, geographically constrained process. Today, global enterprises require capital to move with immediate, frictionless precision. Founders frequently characterize an initial public offering as a final destination, a mechanism for early investors to liquidate positions, or a simple branding exercise. This view misses the strategic utility of the listing. A public listing is the acquisition of a specialized financing toolkit. It is a mechanism designed to convert corporate equity into a liquid currency, allowing a company to raise permanent capital to fund continuous operations. The Nasdaq stock market operates as a digitally engineered ecosystem and a regulatory framework. The first pillar is capital efficiency. Within this ecosystem, a corporation structurally lowers the cost it pays to borrow money or raise equity. The second pillar is execution speed. Using specific structural pathways, management can raise hundreds of millions of dollars over a single weekend. But this agility creates a distinct hazard. If a company can issue new shares instantly, what stops management from diluting existing shareholders into oblivion to cover up their own operational missteps? The answer is strict mathematical governance. Long-term corporate survival relies on balancing these two forces, deploying the public toolkit for liquidity while operating within the regulatory boundaries that protect investor equity. Private capital markets are deeper today than at any point in history. Why would a mature company submit to the intense, costly scrutiny of a premier U.S. exchange? The financial framework driving this decision is the bonding hypothesis. By legally tethering itself to the rigorous governance and independent audit standards of the public markets, a company alters its risk profile. This process is enforced through mandatory, continuous disclosure obligations mandated by federal regulators. The market gains a clear, legally bound view into the company's financial mechanics. This chart shows the direct result of that transparency. By reducing information asymmetry, the risk premium demanded by investors shrinks. Listing on a major exchange reduces a firm's cost of equity capital by an average of 70 to 120 basis points. Companies that list on over-the-counter markets only yield a 30 to 70 basis point reduction. The market recognizes that OTC venues carry weaker regulatory consequences and prices the capital accordingly. Interestingly, firms executing private placements, which bypass SEC registration entirely, often experience an increase in their cost of capital, reflecting the premium investors charge for opacity. Regulatory compliance functions as a financial instrument used to generate a quantifiable discount on equity. Once that foundational discount is established, the focus shifts to execution. When a listed company identifies a sudden, critical need for working capital, it must be able to access the market immediately. For the largest firms, the primary mechanism is achieving status as a well-known seasoned issuer, which grants the ability to use an automatic universal shelf registration. A universal shelf allows a company to register an unspecified amount of various securities in advance. These registered shares sit dormant until management identifies an optimal market window to execute a takedown and sell the equity. A common method to deploy this is through private investment in public equity, or PIPEs. This framework allows the firm to issue large blocks of stock directly to qualified institutional buyers, rapidly securing funds while disclosing the material agreement on an SEC Form 8K. The strategic value of these tools is market timing. Management can execute on macroeconomic shifts without having to wait out a prolonged SEC review period. Historically, raising secondary equity capital meant executing a traditional underwritten follow-on offering. This requires selling a massive, discrete block of shares, which typically demands heavy discounting and exerts severe downward pressure on the stock price. Today, companies bypass that disruption. The dominant modern alternative is the at-the-market program, or ATM. Once utilized primarily by real estate investment trusts, ATMs are now a critical mechanism across the life sciences and technology sectors. This visualization demonstrates the mechanical difference. Instead of a single block sale, an ATM allows the issuer to slowly dribble out new shares incrementally into the existing, natural trading flow of the listed security. Because the shares are absorbed quietly at prevailing market prices, the issuer avoids the pricing discount penalty common to block sales.
This structure reduces investment banking fees, requires no executive roadshows, and gives management the discretion to pause sales during unfavorable conditions or corporate blackout periods. The mechanism has precise constraints. ATM programs require high baseline liquidity to absorb the new shares, and continuous sales can trigger Regulation M restrictions, limiting broker-dealers from engaging in market making. By removing the need for a discrete block sale, the ATM allows management to dictate the terms of capital entry directly, reducing the leverage traditionally held by underwriters. If ATMs and PIPEs allow capital to be raised with such extreme speed, there is an obvious vulnerability. Management could theoretically issue an endless supply of shares to cover up operational failure, eroding the value held by existing investors. To prevent this, the ecosystem relies on a structural boundary, Nasdaq Corporate Governance Rule 5635. This chart illustrates the rule's primary trigger, the 20% rule. If a company attempts to issue new common stock in a transaction other than a standard public offering, and the volume equaling 20% or more of outstanding shares is priced at a discount, the system halts. Prior shareholder approval is required. Nasdaq calculates this discount against a minimum price, defined as the lower of the stock's official closing price immediately preceding the agreement, or its 5-day trailing average. There is only one major exception to this barrier. An independent audit committee can bypass the shareholder vote only if they can prove the delay would result in the immediate insolvency of the enterprise. Rule 5635 enforces a mathematical boundary on management, ensuring that highly dilutive events cannot be executed without disclosure and consent. Rule 5635 monitors corporate power dynamics by acting as a referee for specific equity issuances. Under subsection A, if a company issues more than 20% of its shares in connection with buying another business, a shareholder vote is mandated, even if those shares are issued at a premium price. Under subsection B, the exchange monitors block ownership. If a single issuance results in an investor or group acquiring 20% and becoming the largest single shareholder, Nasdaq categorizes the transaction as a change of control, triggering an immediate vote. The Public Market Toolkit is designed for capital efficiency, but these regulatory tripwires guarantee mechanisms cannot be used to quietly transfer control of the company. We now have the complete architecture of a Nasdaq listing. The system provides high liquidity and a lower cost of capital on one side, bounded by Rule 5635 governance on the other. This architecture is currently integrating new protocols for trade execution and settlement. Capital markets are actively preparing for 23-hour continuous trading cycles alongside the integration of blockchain tokenization to settle fractional equity instantaneously. Simultaneously, artificial intelligence is being deployed to automate the technical complexities of SEC disclosures and Nasdaq compliance reporting. The technology executing the trades will change. The requirement to balance market agility with shareholder protection remains the standard for maintaining public investor confidence. A Nasdaq listing provides a specialized operational toolkit rather than a final corporate destination. Management teams who master this machine, deploying ATMs and universal shelves while navigating governance triggers, can outscale private competitors who lack access to these high-speed capital pathways. Subscribe to Wall Street Review for continued analysis of the mechanisms driving global finance. As capital flows adapt to new technology, which financing tool do you believe will dominate the next market cycle? ATMs or PIPEs? Leave your analysis in the comments.